Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elkanah, and I have Tim Seymour on the line, and he is the founder of Emerging Money. Tim, how you doing on this Wednesday morning?
Morning, Joel. How you doing? Very good to be here.
All right. You got your start on Fast Money on CNBC. Could you just talk about that a little bit? And are you nervous in front of the camera there, or did you get over that pretty quickly?
I'm more nervous now, Joel.
No,
just kidding. Look, the background on that for me is a little probably less traditional than even any other trader who finds himself suddenly on TV and wasn't planning on growing up to be an actor. But I started my career in emerging markets and ultimately moved out to Moscow, was partners in a Russian bank, came back to the U.S. to open up a broker-dealer for these guys. And one of the things that I was very focused on was getting us a little more attention in the media and getting, hopefully dispelling the myths that we were all KGB, et cetera, that we were just smart capital markets guys that happened to be focused in emerging markets, and in this case, Russia. So I called a PR agency, said, just get me on TV. I'd like to, talk about something that we can be smart on, and off we go. And that's really how it began. This is 2002. When both emerging markets and Russia were in a very different place, although Russia seems to have found themselves back in that place. Oil was, $15 a barrel, and we were there to talk about oil. We were there to talk about OPEC. We were there to talk about hopefully smart things in the commodity space, and it just kind of took off from there. But in 2007, actually in 2006, when they were starting the show over at CNBC called Fast Money, the producers called me and said, "Hey, we think you'd be great for this program, and we'd love to have you come kind of read." So it was my first audition, and there was four other guys who were the original four that they'd founded for Fast Money, and they were kind of looking at me to be the proverbial sixth man to come off the bench and fill in where people couldn't. And it kind of all took off from there. And for me, what I was uncomfortable about, that's when I was nervous, and that's really when I said, "Hey, look, for me, I'm a guy that can talk all day long about commodities, macro, certainly the stocks in the world that we were focused on." And at that point, I was a hedge fund manager. I'd started my own hedge fund that was looking at Eastern Europe, that was really the start of it. And I said, "Sure, I can tell you what Ford and GM and Microsoft are doing in the emerging world, and I can talk about all this macro stuff that's driving a lot of these markets, but I'm not sure you really want me to be the guy talking about Intel, that kind of thing." But ultimately what the show is great for, and what I learned to get comfortable with, because the jury of your peers on Wall Street is unquestionably the toughest group of critics, and the ones we tend to care more about than anybody. As long as you are able to articulate a point, you can, I've spent 20 years in the business. I can read any chart. I can look at a company's multiples and their valuation history, and I can drop it into a context and tell you what I think. And what's great about Fast Money is you've got four traders on a desk who have skin in the game, who have been in the trading chairs for a while, and really are giving you their assessment of either how markets are trading on that particular day, or making a stronger thematic, longer term fundamental call, et cetera, et cetera. And so to that extent, we hope we're out there giving people some pretty solid advice and helping them navigate through choppy markets, et cetera, et cetera. We hope we're also just trying to make it a little easier. Try to give people some insight into how we approach our day. Try to get behind the trade. Certainly with global markets and emerging markets, for me, it's about trying to demystify this stuff, because frankly, it's not all that complicated. It's the reason why I love emerging markets and got involved in this side of the investment landscape, is because I think it is very thematic. I think it really is driven by a lot of concepts that most people can get their arms around, and then you drill deeper and start trading from there. So that's a long-winded answer,
A good
but
one,
it's
no?
a great group of folks. Clearly, a talented group of traders. I think the network, continues to be really on the leading edge of what's going on in financial media, even though it's a complicated playing field out there. So, we're all very happy to be doing what we're doing.
Okay, well, let's get right to your expertise then, and that's in emerging markets. And let's start out with China. Perhaps give us a little macro. The local markets are being opened up, and I guess we just got to start with Alibaba, huh? What an incredible run! Give us your thoughts on that. Let's talk China.
Yeah, sure. So to address China first, and then dive into Alibaba, because I think it's important to look at China in a couple different ways. One of the things that I've always scratched my head on is China has been everybody's whipping boy for the last 5 or 6 years, certainly since the crisis, and people are quick to point out that there's a huge credit issue, that there's a huge housing bubble, and that there's a government that's cooking their books. I mean, that's what most people think, and on some level, all those things are correct. But what people tend to miss here is that China is engineering a very long process of trying to move from an industrial economy into a consumption economy. That's a decade long and probably a multiple decade process to ever resemble where the U.S. economy is, where 80% of our GDP is service related, and we're really not an industrial economy anymore. But China has made a shift to where consumption is about 45% of the economy. That was 35% about 15 years ago. But it's a case where, to me, that the government is in a great position to engineer macro policy, and it may not always be the right policy, but China has significant social issues to be cognizant of always, and therefore a lot of policy is dictated really by, on some level, controlling the masses, and therefore when I see a lot of the very public and more recent blow up, say in the credit space, where you had either some of these real estate investment vehicles or things that actually did kind of roll over and die, that's a case where the government was very happy to make them an example. They do need to damp down the property sector. They do need to let some stress out of the credit bubble. Their credit market is actually larger than ours in this country, and that is a little scary. In other words, the amount of outstanding credit to Chinese corporates, when in fact they're about 1/3 the size of the U.S. corporate profile, is a little scary. But anyway, so my view is that people tend to miss how to trade China. The trading the big state-owned enterprises has been something that's been a losing enterprise, and if you look actually at valuations in the local Chinese market, it's trading at about 11.7 times, and it's trading at the low end of a 20-year cycle here. So valuations are actually very interesting. But to me, it's really about liquidity, and it's really about when you look at China, you need to analyze where there are liquidity forces at work and where there's momentum forces at work, and those to me really are things that are changing by the day, and this gets us a little bit into where Alibaba operates, but also where we do see that there is just significant growth in the consumer consumption profile for an economy that, again, is a group of savers. China is not necessarily been a place where the consumer and the retail folks have been levering up over the years. So it's about trying to ease them into a more consumption backdrop. Alibaba is the dominant player, and Alibaba dominates 83% of the online retail market. They are, in terms of their logistics and their infrastructure, similar to, say, an Amazon. At this point, it's their entire ecosystem is one of the more comprehensive globally, and that's part of where kind of the value is. It's clearly everybody knows about what's going on with e-commerce and cloud, but there's a substantial ecosystem which allows the company to really look towards not only today but tomorrow, and of course, Alipay, which is not effectively what people are buying when they're buying Alibaba, but which is their PayPal, et cetera, is something that people really need to kind of get their arms around and figure out how they can get exposure to that. But again, so for the stock right here, boy, it's been a major topic for global markets, and since the IPO, this is a company that actually has effectively doubled if you figure where the stock was due to come on opening day. So what was a reasonable valuation, I think the stock was, at least in the roadshow, was the discussion was somewhere between kind of 25 to 27 times earnings. The stock now trades, I'm guessing, I'm looking here, it's about 60 times 2014, and about 53, 54 times 2015 estimate. So it's far from a cheap company. I think there's a number of drivers that people should be looking at. There's massive upside, I think, in their mobile. If you look at the numbers that came out of Singles Day, which is what we just went through, 11/11/11. For those folks that haven't really paid much attention to this, this is Black Friday and Cyber Monday and Thanksgiving all rolled up into one on steroids. And clearly the numbers that they came through with yesterday were 9.3 billion in sales, blew away the numbers from 2 years ago and last year's 5.9 and dwarf what's going to happen this year in the States. So anyway, the attention on all of this is something that I think you can then back out and take some. There are takeaways for looking at China overall, but I think Alibaba is a very interesting company in that it's dominant now, but I think it's positioned to dominate at least for a few more years. And it's very clear that the Chinese government is on board with this. I think Tmall, which is Tmall Global, which is essentially a subset here of Alibaba, and where people shop, so to speak, and shopping in China, by the way, really is it actually is a much more personalized experience. People shop; they take a lot more time. It's culturally, it's one of these things where Alibaba is doing a great job in trying to convert a group of people that really would almost feel like they're being shortchanged by shopping online. They want the full experience when they're out there buying something. But I think Tmall is definitely a cultural kind of center, believe it or not. And I think ultimately what's also going to happen here is that there's a cross-border and inbound e-commerce market in China that's a big part of the story. So again, if you look at the Singles Day numbers from yesterday, the amount of sales that were coming from Taiwan, from Hong Kong, and kind of the region are really extraordinary, and part of the reason why you should be excited about Alibaba. It's a global play. They signed up merchants in 200 countries. So it's the largest online and mobile commerce company in China and in the world, as measured by their GMV, and it's very much involved in cloud and third-party service providers on payment and financing and logistics. So it's all that people have talked about, but be careful, investors. I wouldn't say you have to jump in and own the stock right now. Stock pulled back a little bit yesterday as you kind of sold the fact on some of this news. But I do think it's a case where it's a company that I'm actually long and expect it'll be a core part of my portfolio for some time.
Got a question coming out of the chat here from Sheldon McIntyre, Hurt Capital. How clean or accurate is the Chinese official economic data, and what are the best sources for Chinese economic data?
Yeah, that's a great question. I think if you look at a lot of the government data that you get on a monthly basis, it's there's some volatility within the ranks. I think the GDP data is like any GDP data. It's limited in what it tells you, but that there's certainly some sense that there are targets that China feels that they need to hit, and if they don't feel that the economy is either in that in that sweet spot, or if they feel as if they're actually intentionally trying to guide down expectations and reduce speculation, they will often come out and you'll hear at some of the communist plaintiffs, et cetera, that they'll guide down some of the growth numbers. So if I look at the PMI numbers that come out monthly that are kind of the most closely watched, I think, China indicator. There are the state data, then there are the investment banks that do data on this. HSBC does a nice job with a PMI reading, which I think a lot of people feel is a little bit more credible. But if you look at those two series and compare them, I mean, they are largely running in parallel. There is some deviation statistically, and there's sometimes on a month-to-month basis you have one that really is an outlier. But I think it's important to look at that. I think the things that you want to try to look at if you have access to this type of information, look at inventories and commodities. Look at billet prices in Shanghai. Look at iron ore inventories. Look at copper inventories. Try to get a sense on really where the underlying economy is seeing demand and where it's not. I think the sales numbers for a lot of the big multinationals in China are also very important, to the extent that it gets back to my earlier point, which is you can't always you can't always judge the Chinese economy based upon hearing what's going on with retail sales or imports and exports or industrial production or fixed asset investment. You need to understand what's really going on in the sales channels for people like Nike or Tiffany if you're looking at luxury, but even Procter and Gamble or some of the big more kind of consumer staples companies that are very active in China. You want to look at their numbers. You want to see where they're seeing fall off in demand or where actually they're seeing demand. And what's often been a great buying opportunity for investors who are playing in multinational stocks is when you get some of this. Either you have one retailer or if you're one global player who's had issues in China, maybe they're issues that are more related to some type of a regulatory issue, or maybe they actually are truly seeing a fall off in their underlying demand, and sometimes it's imputed across an entire sector or across multiple sectors, and that's usually makes for an opportunity to actually be buying, because what we've seen is, and what I think is, again, back to my thesis on China, I think it is really one of the great consumption stories. I think it's one of the great, kind of luxury brand consumers, and the demand. And granted, it's in a very small part of the population, but it doesn't take much to in an economy with 1.3 billion people, that it's such a massive market for people like Tiffany and Nike, that I continue to think that that's where they're going to see all their demand.
Okay, we're on the line with Tim Seymour. He's founder of Emerging Money. Tim, just to wrap things up here, what ETFs do you like for overall emerging market exposure?
Well, I think it's one of the things about emerging markets that people have painfully experienced over the last, say, 3 or 4 years is that the rising tide doesn't take all boats, and certainly rising global markets haven't taken all of emerging markets with them. So, looking at the EM or the VWO, which are the two big ETFs that mirror the MSCI EM or the MXEF, they are ones that have, on a multiple year basis are basically sideways, while the S&P and even the DAX or other parts of Europe have gone to all-time highs. So I think you need to break emerging markets down country by country. I think you need to be looking at areas. So if we take the current backdrop, where let's just assume that the trends that are a stronger dollar, weaker commodity prices, and risks of interest rates at least starting to move over here, or that cross-border asset flows or capital flows that have come from easy money may begin to retreat a little bit. So take that view and say, then I probably think that those economies that are closely linked with commodities and closely linked with either easy money or going to be not necessarily ones that can operate in a world where global growth is slightly slower. So we're obviously talking about Brazil. We're obviously talking about Russia. We're obviously talking certain parts of Latin America. There's that are at least heavily commodity dependent. And I think looking at emerging markets, there's ETFs for every country. And I think I would encourage people to take a look at right now the places where there's been the most focus on reform. So if you're looking at Indonesia, for example, the IDX is the market vectors ETF that's focused on Indonesia. Indonesia is truly delivering on reform. It's a place where earnings growth is reasonable, and I think the valuation is reasonable, all things considered. Turkey, TUR is the iShares Turkey ETF, and this is Turkey to me is caught kind of in the middle. So Turkey is a major beneficiary of lower oil prices and lower commodity prices, and Turkey at the same time is a country that people think about when they talk about, oh wow, what's going to happen when the Fed really begins raising rates, and all these kind of cross-border flows that flowed into emerging markets are going to leave very quickly. And they have. Turkey's typically funded themselves from foreign asset flow. So people often talk about the current account deficit in Turkey as being a big risk. Well, I think actually that Turkey's risks tend to probably be a little overstated. I think it does very well in a backdrop where oil prices are weaker. And for example, if you look at Turkey over the last 4 weeks, as we've all been focused on oil, Turkey's up in dollar terms about 8%. So that's a place that I think is kind of interesting. I talked about Brazil, so the EWZ is the iShares Brazil Fund. I actually believe that Brazil, which is down 10% on the month, we had elections October 23rd, and we had a place where people have had a chance to not only digest whether October 26th. I'm just looking at my calendar trying to verify that. But whether Lula is going to implement any real reform that's going to change the path of the Brazilian economy, which has been on a low power mode and been struggling as China struggles to import commodities. I actually think that Brazil's priced in a tremendous amount of bad news and a very negative outlook towards reform out of Dilma. So I think we're in a place, and I think I might have just said Lula, so correct me if I'm wrong. We're talking about Dilma,
okay.
Dilma Rousseff,
right.
who is the current president. Lula was the man where Brazil rose to glory. So just to be clear, it's different times, and it's different times for the commodity space. And therefore, I think that's how people are looking at Brazil. But the one thing about ETFs, which is also a limitation, so I talked about how it's just buying the EEM or the VWO has not necessarily done much for you, and yet if you've been an investor in Indonesia or India or certain parts of even Central Europe, you've done very, very well in the last couple of years. Country ETFs also certainly limit your ability to have exposure to the underlying parts of the economy and the market that are moving. So take Brazil. If I own the EWZ, I'm so saddled with Petrobras and Vale that I don't really get to really see some of the good stuff, or at least I'm weighted down by those companies that are suffering for all the reasons we just spoke about. But I have the banks, and they're very good banks, and Banco Itaú and Banco Bradesco, ITUB and BBD are the tickers. Those are companies that I actually think are worth owning in this environment.
Okay,
there are
Tim.
retailers.
Tim, we are running up against the clock here, and I have a whole list of questions I wanted to ask you. Would it be possible to talk to Brianna and perhaps get you back on again, because you're just a wealth of information here, but we're up against the clock. Tim Seymour.
Yeah, we'd love to do it anytime. We'd love to do it, and clearly you can tell I love to talk about this stuff.
You do, and you're just like a wealth of information. Tim Seymour, founder of Emerging Markets. Thanks for joining us, Tim.
It's my pleasure. Talk to you soon.